The stock market is currently closed, and the latest official closing figures for NUBURU Inc., trading under the ticker symbol BURU on the NYSE American, show the stock finishing its last regular trading session on Friday, July 10, 2026, at exactly $0.1481 per share, representing an intraday upward movement of 15.38% from its previous base. While a sudden double-digit daily percentage leap usually suggests a speculative retail frenzy or a fleeting momentum spike, the reality under the surface reveals an entirely unexpected structural shift that has caught short sellers completely off guard. Most market participants looking at a sub-dollar stock assume the company is in a terminal death spiral, yet the latest financial disclosures show an aggressive balance sheet cleanup where the company wiped out its massive $15.18 million stockholders' deficit from the end of last year and replaced it with a positive stockholders' equity of $2.17 million. This fundamental shift effectively satisfied the strict listing compliance metrics of the exchange, keeping the equity alive and forcing market observers to reconsider the true trajectory of this enterprise. Establishing common ground across the wider investing landscape, the general consensus among everyday market participants is that micro-cap equities trading below $1 are nothing more than highly dangerous lottery tickets, far detached from the stability seen in institutional anchors like Tesla stock, Apple stock, or Nvidia stock. Many individual investors seeking basic online investment avenues or automated allocations through services like Schwab Intelligent Portfolios completely filter out microcaps due to the extreme daily price volatility and historical dilution risks. The conventional wisdom states that once a technology firm sheds over 90% of its historical valuation, its core intellectual property loses practical commercial viability. However, challenging this standard narrative reveals a fascinating mismatch between market perception and operational execution. While retail sentiment remains highly skeptical, institutional positioning and strategic corporate realignments indicate that this entity is transitioning from a struggling industrial component manufacturer into an integrated defense and security platform focused on directed energy applications, counter-drone systems, and automated military hardware. Examining the recent trading mechanics of this security reveals an intense battle between high-volume retail speculation and institutional accumulation. The trading volume during the recent session swelled to over 75 million shares, a massive explosion compared to its three-month daily average of roughly 33 million shares. This heightened velocity shows that capital is actively rotating into the asset as traders look closely at the daily price corridor, which has fluctuated widely between a 52-week low of 11 cents and an intermittent high above $4. For individuals engaging in self-investing via major online platforms or utilizing an individual brokerage account to capture quick gains, these rapid swings offer significant tactical opportunities, though they carry immense structural risk. When investors look for investment help or browse through standard investing sites to evaluate microcap tech, they often look at trailing metrics which fail to reflect real-time structural agreements. Active traders executing strategies on the Interactive Brokers platform who carefully monitor Interactive Brokers fees and optimize their individual portfolios through an Interactive Brokers account are increasingly looking at the option chains and volume distributions to see if institutional accumulation is quietly taking place under the cover of retail volatility. To understand the core mechanics of this business model, one must look past the immediate noise of the equity market and analyze the underlying physics of their primary asset. The enterprise originally built its reputation on the development of high-power industrial blue laser systems. Traditional industrial lasers rely heavily on the infrared spectrum, which suffers from poor energy absorption when applied to highly reflective non-ferrous metals like copper, gold, and aluminum. By operating within the blue light spectrum, the technology achieves absorption efficiencies that are up to 8 times higher than standard infrared equivalents. This physical advantage allows for dramatically faster, cleaner, and more precise welding and additive manufacturing operations across critical sectors such as electric vehicle battery production, aerospace engineering, and consumer electronics assembly. For retail users managing their holdings through the Robinhood app or exploring specialized asset allocations via Robinhood Investments, the traditional view was that the industrial application would drive long-term cash flows. But the market narrative shifted dramatically throughout early to mid-2026 as the executive team realized that the exact same high-power blue laser architecture could be weaponized and adapted for modern tactical warfare. This brings us to the core tension between expectation and reality regarding the company's long-term commercialization strategy. The market expected the company to remain a niche component supplier, struggling to fund its capital expenditure requirements, regularly turning to dilutive equity offerings that destroyed value for long-term holders of Robinhood stock trading assets. The reality is a swift pivot into the global defense and security sector, specifically targeting the multi-billion-dollar counter-unmanned aerial systems market. As modern conflicts showcase the devastating impact of cheap, mass-produced drone swarms against highly expensive traditional air defense systems, militaries worldwide are desperately searching for cost-effective non-kinetic countermeasures. The high-power blue laser platform provides a direct answer, offering a virtually unlimited magazine capacity and an exceptionally low cost per shot to neutralize incoming airborne threats. Investors managing tactical portfolios through SoFi Invest or allocating capital via a SoFi robo-advisor are beginning to recognize that the company's recent contracts with major government defense electronics organizations represent a fundamental diversification of their revenue stream. Let us pause for a moment to gauge the sentiment of the community. Comment below how many shares of NUBURU stock you currently hold in your portfolio, or share your thoughts on whether you believe the microcap defense sector offers genuine upside or simply too much volatility for an individual brokerage account. Looking closer at the macroeconomic pressures and recent corporate actions, the strategic acquisition of the Italian defense firm Tecne S.p.A. stands out as a highly sophisticated operational move. By executing a stock purchase agreement to secure a majority stake in Tecne, the company did not just buy additional manufacturing capacity, they integrated an established defense infrastructure company that designs electronic warfare systems, tactical military mobility platforms, and software-orchestrated security frameworks. This acquisition instantly expanded the company's total asset base to over $76 million by the end of the first quarter of 2026. However, the international nature of this deal triggered a formal Golden Power notification review by the Italian government, the strict regulatory mechanism designed to protect critical national infrastructure and strategic defense assets. While the general market viewed this regulatory review as a negative bureaucratic roadblock that could potentially collapse the transaction, sophisticated market participants using advanced tools like the Fidelity trading platform or managing institutional funds through Fidelity Wealth Management recognized that this formal integration process actually validates the strategic importance of the blue laser tactical technology within the broader European defense architecture. Financially, the contrast between historical losses and current execution highlights the classical expectation versus reality framework. In the first quarter of the prior fiscal year, the company reported an alarming net loss of $16.61 million, leaving investors who held the stock via traditional Fidelity investments or specialty Fidelity mutual funds deeply concerned about insolvency. Fast forward to the first quarter of 2026, and the net loss has been dramatically compressed to just $459,000. This massive reduction in cash burn was achieved alongside the initial generation of commercial revenues from their newly integrated operating subsidiaries, Liacon and Orbit, which contributed hundreds of thousands of dollars to the top line during their very first full quarter of consolidation. Furthermore, management aggressively optimized their balance sheet by reducing a substantial preferred stock obligation related to the Orbit transaction from over $8 million completely down to zero, converting that liability into common stock equity and freeing up critical working capital to fund their near-term industrial expansion. For individual investors navigating the modern landscape of online investing, choosing between standard low-risk assets like Fidelity ETFs and highly speculative tech plays requires a clear view of future catalysts. The immediate pipeline for the company includes a $2.2 million Blue Laser rover opportunity, which directly supports their stated revenue targets for the remainder of 2026. Additionally, their contractual joint venture with Maddox Defense Incorporated for a mobile additive manufacturing program has advanced into a fully funded prototype build phase designed to secure direct United States government demonstrations. When users track these milestones on mobile trading tools, whether checking their positions via the Robinhood Cash Management tab or executing fractional